Hi, we'll give maybe a minute for the attendants to come in. Okay. Good morning, everyone. Welcome to our first IR4U webinar series for this year, entitled 2024 Outlook Positioning for Big Policy Reforms. We are very delighted to have the Head of Research of Macquarie Malaysia, Mr. Ben Shane Lim, with us today to talk about the 2024 outlook. And Ben will unpack key policy reforms, particularly the fiscal reforms that will see unwinding a blanket fuel subsidy and transitioning towards targeted cash handouts and the implication to the overall economy. Before we begin, I'd like to remind all the participants here that you can put in your questions at the end of the webinar later, and I'll have them read for you. Without further ado, let's please join us to welcome Ben. Yeah, Ben, the floor is yours. Thank you.
Hi, good morning, everyone. Thanks for your time today. Maybe just a quick introduction on myself, my team. So I'm heading the research team here in KL. I've been looking at capital markets for over a decade now, although I did start off in journalism with The Edge. I've been with Macquarie for over 5 years now. So myself, I cover strategy, banks, a bit of tech manufacturing. We have a team of 4 here in KL, but we also have some regional analysts helping cover our stocks here in Malaysia. So jumping into our outlook for 2024. So this is a brief overview. I won't go into too much detail here, but broadly, we think on the policy front, some interesting things are happening finally. We think the government will go ahead with the unwinding of fuel subsidies, blanket fuel subsidies, and this actually aligns with COP28 commitments. And this, we expect them to transition towards more targeted subsidies and cash transfers. At the same time, the government is also continuing to push ahead with its energy transition roadmap. We think a key milestone here will be finalization of TNB's RP4 framework this year. It has to go live by next year, as well as the TPA framework. We think another theme here on policy front is also, very supportive of FDIs. I think trade war is probably going to continue being front and center of US-China relations. And I think that's continuing to support Penang tech investments. We're also seeing data centers as a theme in Johor, also tied back to the energy transition thematic. And also we are seeing, Sarawak potentially being a bit more assertive, and one of the things in the pipeline is reported sovereign wealth fund that's being set up. And finally, on a policy front, something that we'd like to see tidied up will be around the telcos, so the dual wholesale network, or at this stage still a single wholesale network set up, and how the sector will be structured going forward. On the macro front, we do expect GDP growth to be about 4 to 5% this year, potentially with a bit of an upside tilt. And I'll come back to why we think the risk is to the upside. And for inflation, there's a big band on what inflation could play out this year. If the government does unwind fuel subsidies, the inflation will hit the higher end of our expectations of 3.5%. Otherwise, inflation could actually come in below 3%. And we're seeing that the broader global environment is quite disinflationary at this point in time. We also expect the central bank will hold the OPR unchanged at 3%. This will be in stark contrast to the Fed, which is expected to cut rates quite significantly in the second half of this year. On the labor market side, it remains very tight. Wage growth has been quite robust. We can see this even with other indicators like EPF net contributions picking up quite a bit. And this has been a trend since the pandemic lockdowns ended. And in fact, labor market is a lot tighter than it was pre-pandemic. This could be somewhat offset with relaxation of foreign labor import, and also a bit less friction, for foreign labor to transition from one sector to the next where demand is higher. On the export side, there's some signs of recovery. We're still below potential, particularly I think on E&E after building a lot of capacity. But there are certainly some sectors within exports that will be challenged, like gloves. But overall, the one area that looks the weakest in our outlook will be commodities. As I mentioned, we're in a disinflationary environment, and typically that's not great for commodity prices. So CPO and oil, we are a bit more bearish this year. On the external side, we are positive on China tourism. With the visa-free travel implemented in December, we're starting to see a bit of a pickup there, and also maybe some avoidance from riskier or perceived riskier destinations like Thailand. I mentioned a bit on trade diversion, and we think that the noise around the US elections could drive further focus on supply chain migration. Penang remains one of the top destinations in the region, but it's become so full that even spillover into surrounding areas like Kulim and Ipoh has also come into focus. And finally, on the Fed rate cuts, as I mentioned, we expect cuts in the second half of this year. Our forecast specifically is 200 basis points. We think the market's probably pricing in for half of that, at least at this point in time. Pivot in interest rates is typically a highly volatile environment. It doesn't happen in a straight line, and expectations change rapidly based on the data that's available. And I think this generally is supportive of the ringgit. We have a 4.5 target for this year. And this also provides some relative NIM resilience for our banks, at least relative to the region. So this is a quick overview, for our market preference. We do think that Malaysia ranks second overall within ASEAN. And generally, one of the big calls we have is having Indonesia lower down the order of preference. And this is largely around the fact that Indonesia is very well owned, and politics there looks a little bit more volatile this year, whereas maybe Malaysia, Thailand, we've got that behind us. Malaysia, even with the upcoming inauguration of the new Agong, we expect the political environment to remain stable into the next election, and that will help us, while Indonesia maybe goes for 2 rounds of elections. However, Malaysia does have weaker valuation and earnings, upside for target prices, so that generally caps us. But on a relative basis within the region, we're starting to look a lot better. Just a quick recap on our KLCI target. Now, this is slightly dated following the index balancing, but our target of 1570, which was originally published in November last year, market has converged significantly on this. And you can see that we're actually expecting a lot of the upside from sectors like banks and energy, whereas we are expecting a drag from plants. As mentioned, the commodity side is going to be a bit more challenging. Broadly, we still don't expect the KLCI to re-rate to the long-term historic average of 15.3 times PE. And the reason for that is that some sectors remain structurally derated, specifically things like plantations and telcos. Plantations for ESG, selling pressure, telcos, because of the policy risk, and utilities, particular struggle with ESG as well. Basically, it's a big pool of investors that just won't touch these sectors anymore. And we've seen that also reflected maybe even in foreign shareholding data coming down. So that kind of prevents the broader market from just blindly re-rating to mean. Now, let's get into the fun stuff on the policy reforms. So this chart on the left gives you a feel for the implementation timeline. And the way we thought about it is that the government really can't implement major policies close to the next elections, right? At least risky ones. And the next election is typically going to, typically, it's going to be in the second half of 2027. So if you assume a 1 or 2 years of cooling off before elections, the government actually has a very limited implementation window for, hard-hitting policies like, fuel reforms. So really, they have to start latest by middle of this year, and they probably can push that until middle of 2025. We think that, sort of the start of this year is actually around, setting up Padu, getting it right. And I know there's been mixed reviews on that. But really, it's out of necessity that the government has to hit its mark within this very narrow implementation window. I think it's interesting to point out that the government has actually done something like this before, but not quite in this order. So when you think about fuel subsidy reforms, actually this was done back in Najib's time. It started with actually the BRIM handouts in around 2012. Before the elections. And then after elections, that's when all the fuel subsidy reform, electricity tariff reforms all kicked in. And then GST came after that. So the government was implementing a lot of these policies at just after elections, but keeping a sufficient buffer before the 2018 elections. So ultimately, a lot of these policies were unwound by the Pakatan government. But the point is that it's actually been done before, maybe not on this scale, but also potentially we've not had this sort of urgency to manage the fiscal consolidation as we have before. Now, I think it's important to put the fuel subsidies in context. The government is estimated to spend about 65 billion ringgit on fuel subsidies in 2023. That's a huge amount. Pre-pandemic, a bad year would see the government spending about 20 billion on fuel subsidies. And a lot of this is actually consumed by businesses, as you can see here, but also a new element has emerged, which is leakages. Now, leakages can be classified in a few ways. It could be hard leakages across the border, but it could also be, any consumption by non-citizens as well. If we think about the average household consumption, and Department of Statistics kind of helps us build this number up, households only consume about 20 billion plus of subsidies each year, and then about maybe another 30 billion by businesses. So really, if the government is able to implement the targeted fuel subsidies rather than a blanket one, which is susceptible to leakages, the government can actually very quickly save this 20 billion estimated leakages on the right-hand side. And what's driving these leakages really is the huge disparity between our pump price and the pump price of our neighbors. And you can see historically, we did maintain a certain range with our neighbors, but that has expanded quite significantly over the past couple of years, both for RON 95 as well as diesel. And this has really catalyzed smuggling. If you look at retail fuel sales historically, it's actually quite stable. You can imagine that new cars on the road don't actually grow by that much. People can't actually drive that much more. But post-pandemic, volumes are actually up by about 45% versus the baseline. So that gives you a sense of potentially the leakages that are taking place. So I think the way to think around this problem is that in a perfect world, the government could implement enforcement and prevent the leakages, but in practice, they can't. So wearing an economist hat, the best way to address this is by removing the subsidies. Now, the government will probably, and again, the government has not been too explicit about how they're going to implement it, so I have to make some assumptions here. But we think they can go ahead with a combination of direct cash transfers, digital fuel cards with quotas, and potentially, specific subsidies on specific goods. And the reason, of course, the government needs to do this is if you raise the pump price, it's going to be inflationary on the whole economy. We think that the government will probably go on a monthly transfer / quota. Again, this is to prevent a huge spike in inflation as well. Maybe especially in contrast to BRIM, which was done on a yearly or bi-yearly basis. The government has a very clear mechanism to do this. They have a tested method, which is via e-wallets. And e-wallets are incredibly versatile to do this because they can even discriminate down by specific retailers. So, for example, if you say like, okay, we don't want people to buy alcohol, and there's certain types of, retailers that only sell alcohol, you could ban them. And in practice, the e-wallets could actually go down to SKU level and actually eliminate, let's say, buying alcohol or tobacco, so people can't abuse some of these cash transfers. The cash transfers also will be skewed towards the low income and vulnerable groups, which is obviously going to be a core to the government's voter base as well. And the criteria will be a combination of household income and or individual income. Again, we don't know specifically how the government will implement this, but the government does have a lot of data to do so. And they're going to fine-tune this via the centralized database, PADU. Now, the implications from this is that it's going to be inflationary, right? Removing the fuel subsidy, which we think will be done in stages, will be inflationary. And generally, cash transfers are also inflationary to the economy. Hence, our inflation expectation on the high end of 3.5%. And that also feeds back into the reason why we think the central bank will hold rates at 3%. This inflationary spike is something that the central bank cannot predict. They don't know the timing, mechanism, or quantum. I know they are in discussion with the government, but the policymakers can be a bit unpredictable. So the central bank has to take a hawkish footing, keep rates higher than maybe what they would like, in order to preempt this inflationary pressure. However, we also think that because the blanket subsidies will be transferred to a targeted subsidy that targets the low-income groups, generally this should be stimulative for growth as well, because the cash that you give to low-income groups that have high propensity to spend should be stimulative for the domestic economy overall, at least on nominal terms. Another interesting theme here is we think it should be a catalyst for EV adoption. We think that the country has been in a paradigm of low and stable, pump prices for a long time, and that could change quite drastically, in the next 1 to 2 years, and really drive adoption for EVs, which maybe now may not make economic sense. And also, this is probably negative for retail fuel operators. It sort of kicks off some volume destruction for them. You can see again, the volume's definitely much higher than what it was pre-pandemic. But also, with the higher adoption of EVs, right, it'll put into question the long-term viability of that business model. Broadly, the two sectors that we do like from this is financials. We think that some sort of cash transfer, in the context of a broader social assistance program, will actually give better income stability, especially to low-income households, many which maybe are on day wages, gig work, could be very unpredictable. This will actually impose some stability, and also potentially improve their debt service ceiling, even if they were to, substitute their current income streams and be no better off. And also positive for the consumer sector. The consumer sector benefits from the disinflationary trend outside of Malaysia, but also if the government is taking care of the low-income groups, it potentially will help them maintain their spending power. But if the government is a bit more generous and gives them a bit of surplus, we expect it can translate to better discretionary and out-of-home spending in particular. So let's look very quickly at how the households consume their subsidies. So this is based on a survey by the Department of Statistics. So it's not very, very comprehensive. There's some standard deviation here. But really, we can see that the average bottom 20% of households consume about 240 ringgit per month on transportation, of which they spend about 150 on fuels. Lubes are included in this bracket by DOSM, but we can assume it's mostly fuels. And then we can work out, estimate the subsidy that they consume is about 85 ringgit a month. On the other side of it, the T20, so the top quintile here, they consume about 300 ringgit in subsidies a month. And we can work out to the annual fiscal cost to the government. So the T20 consumes 6 billion, whereas the bottom 20 consume about 1.6 billion. In total, we worked it out to about 17 overall. But again, these are just based off the household expenditure numbers. Actual consumption could be higher than this. And what you find is if you run a simple assumption here and say, hey, look, let's just not give the T20 the subsidy, right? Let's wave a magic wand and they stop enjoying a subsidy. Immediately, the government saves about 6 billion ringgit, which is quite substantial. Now, you can also assume that the government wants to take care of the low-income groups. So in this second scenario, you can assume that they transfer downward this gain to the low-income group. So we give the cash transfer to the low-income group of 350 ringgit, right? And at a cost of 5 billion to the government, but you also penalize maybe the M40 a little bit. And the government still has a fiscal break even, but you can actually have pretty significant cash transfer potential to the lower income groups. So again, this is all just illustrative to give you a feel for what can be done. And I think it's useful to think about it in that context. It's not by any means what the government is going to do, but it shows you the fiscal headroom the government has to play with, while being no worse off and keeping a large proportion of the population on site in an inflationary environment where fuel prices are going up. Um, of course, we also can think of the more extreme scenarios, right? What if the government wants to transfer more money to these low-income groups? So if the government is willing to, spend 16 billion, and really the thought process around here is that they're going to get quite a lot of fiscal savings, from leakages. They could actually transfer quite significant sums to the low-income groups. Now, again, I use cash transfer as a sort of a blanket term, but potentially this could be broken down to certain proportion can be used for as a fuel quota that you use or you lose. Some could be like a sugar subsidy specifically, right, with quotas in place, and some portion could be cash transfer. On the other side, you could think about, just the government saying, hey, look, we think inflation is going to be very high for low-income groups, right? A lot of the goods they consume are a bit more volatile. So the government say that we want to give you 15% inflation protection, for the lowest income group. They could still get about $300 a month. The issue, of course, with this kind of approach is that the more you spend, the more the government has to give you. So like suddenly you get a B40, on the same 15%, they're getting 500 ringgit per month. Again, this is all illustrative, just to give a feel for how the numbers add up. And how can we think about this from a fiscal balance perspective? So coming back to that scenario 3 and 4, so the government is currently spending about 65 billion here. You assume a little bit of volume growth, but really the savings comes from this smuggling curtailment. So you cut down the smuggling here. You assume some demand destruction, which we assume is largely inelastic. And then you have about 80% subsidy removal. This is the real savings that the government gets, right? Lowering the pump price. Now, our illustration here, we've assumed that the pump price goes up to 325. Not immediately, but for simplicity, we've assumed on an annualized basis. So this removes about 80% of the subsidy. We've assumed some residual subsidies, again, fluctuations around the global oil price and all, so we left a bit of buffer here. And this is after taking into account cash transfers. So this 22 is really the aggressive cash transfer scenario. Another 10 billion we've assumed transferred to businesses. So let's say the government wants to protect farmers, fishermen, right, targeted groups. They can still get about 19 billion ringgit in savings. And in scenario 4, the inflation protection scenario, a bit more middle of the road assumptions, the government could save 30 billion ringgit. So again, this just illustrates that the government can still be quite generous with some of its, targeted subsidies, but really get huge savings, particularly from smuggling curtailment. I think it's worth putting some numbers out there on how this may affect transportation. So if you look at car sales actually chasing record highs, so I think certainly higher pump prices could put some pressure on the broader automotive industry. But it's also worth noting that there's a couple other dynamics at play. Old and inefficient cars on the road will probably need to be replaced. We ran the numbers, and just switching from a pre-2012 MyV to a post-2012 MyV with higher efficiency could save you somewhere like 1,700 ringgit per year. And that's assuming typical mileage about 28,000 kilometers per year. And if you look at toll road traffic, right? Maybe your experience may vary, but you may feel that it tends to be either a bit less congested or very congested nowadays in KL. The traffic patterns have changed, but the data suggests that generally road usage has fallen a little bit. This is 2021 numbers, so slightly dated. But the road usage may not have fully recovered, at least toll road traffic. Public transportation certainly has fallen quite a bit, versus pre-pandemic. This could be some of the social distancing hangover from the pandemic. But we suspect, and again, this is a 2022 number, we suspect there could be a catalyst for people to use more public transport, reducing dependency on roads. And lastly, this data on traffic at selected locations, again, the 2022 number, shows a bit of a sharp rebound here. And we think that, maybe people could start driving a bit less as well if pump prices are higher. Now, Um, I think maybe another takeaway here is that the investment is not just on the for households to consider, but also businesses. Businesses that are running old lorries, old machinery, anything that's a bit energy intensive and inefficient, will probably need to revisit some of those investments. So in fact, higher fuel prices could be a catalyst for more private sector investment as well. Now, financials are quite interesting as well. What we saw post-pandemic, anecdotally from the banks, is that repayment behavior has been poor, even though people's ability to service debt has improved. So when you think about it, the banks gave a lot of indulgences over the pandemic, a lot of extensions and so forth. So maybe people took advantage of that and are not as disciplined in maintaining their repayments. So we think that if with a bit of cash transfer, the low income groups could potentially be a bit better about servicing their debt and maybe even have better debt servicing profile again from the income stability. But it's also worth mentioning that low income groups typically have very low exposure to the banking sector simply because, well, they have a smaller balance sheet. So for the overall banking sector, borrowers that earn under 3,000 ringgit, only 10% of the banking sector. So they may not be so significant at the bottom end of the banking sector. But financials with high exposure to low-income groups will probably benefit a little bit more. We also expect that this could translate to better loans growth appetite for the banks. You can see that maybe demand for certain types of cars, as mentioned earlier, could improve. People need to phase out some of their old vehicles. And generally, consumer loan applications have been quite strong post-pandemic. So this could help sustain this trend rather than drive growth, and so keep this demand above trend for longer. And again, this could circle back to the fact that the banks may be more comfortable lending to low-income groups, given that their income stability has improved. Their underlying asset quality has actually improved. The another factor to consider for the banks is that it could help improve liquidity in the banking system. As the government does this cash transfers, right, it basically injects liquidity into the banking system. It could also encourage cashless adoption. So one way that liquidity leaves the banking system is every time you withdraw money from the ATM. Otherwise, if you transfer something to someone over your e-wallet or through Do It Now, right, from bank to bank, the money stays in the banking system. So if these transfers are being done on e-wallets and people are not withdrawing in physical cash, they are consuming it, digitally as well. That could help boost liquidity in the banking system, and that's something that has hurt the banks a little bit post-pandemic. You may be aware that the banks are struggling a little bit with their high deposit rates, trying to compete for that liquidity. And of course, e-wallets could be a place where some of this value gets captured. We can already see that ATM withdrawals are on a downward trend. E-wallet adoption has been rising. Even maybe average e-wallet balances haven't improved too much, but e-money liabilities have improved quite a lot. Excuse me. And you can see that transactions, particularly for e-money, still lag far behind debit card and credit card, at least by value, but by volume, actually, it's quite significant. And of course, Touch and Go easily lays claim to having the largest share of previous government cash transfers. So that's something to think about as well. Maybe I'll skip past the NIM concerns, but broadly, on the higher liquidity, this should help the banks as well. Our banks also look interesting because our central bank is going to hold rates flat. In contrast, some of our peers in the region, like especially Singapore and Indonesia, they tend to track the Fed rate cycle. And you can see that they followed the Fed rate hike. And when the Fed cuts rates, they're going to have to follow it down as well. Whereas Malaysia and Thailand, to some extent, we're going to hold our rates within the current band because it's sort of our neutral rates at this point in time. And that means that rate differential will help our banks. Really, the banks that are in regimes where the interest rates are being cut will face NIM compression, whereas our banks, on a relative basis, will be a bit more resilient. Lastly, on the inflation front, generally, I think while there will be temporary upward pressure on our inflation, it should be well contained overall, simply because some of the I call it the neutral rates currently imposed are already starting to curtail credit velocity in our market. On the export side, I would say that's probably an area where it could be a big swing for us this year. I think in particular, the two wild cards for us to track will be the US economy as well as the Chinese economic recovery. But broadly, it does look like the US is headed towards a soft landing. I think it's been dubbed a bit of a Goldilocks situation for the US, where inflation is under control, but growth is still present. On China's side, the recent cut of the RRR also is stimulative in nature and should have a positive read-through to our economy. Just quickly recap, EV demand could grow quite significantly. We think that EVs penetration could go up to about 1 million units on the road, by 2030. And it could be a pretty significant 67% CAGR market going forward. Really, the only challenge for the EVs now is that it's still quite expensive. We have BYD being one of the cheapest at 100,000 ringgit, but we really don't have EVs cheaper than that at this point in time. So that's something that we'll probably need to change from a policy perspective going forward. But it appears that there's still some protectionism for our domestic market at this point in time. On the aviation front, stepping outside of the policy conversation, we're quite positive here. We think that there's been a lot of pressure, especially on places like Thailand. Malaysia pre-pandemic was fifth behind Thailand as one of the top destinations for China tourists, and that could certainly change. We're already seeing some of the preliminary data for the start of the year showing a pretty decent influx into Malaysia. But Singapore has sort of balanced this out as well by also imposing some visa-free travel to Singapore, which could compete with us. So just wrapping things up, we've seen a pretty strong start to the market this year. In particular, we've seen utilities and to some extent health. This is really driven by the glove makers rally quite a bit. So the chart on the left shows you the actual performance of the key sector indices on Bursa. And the chart on the right shows you the consensus 1 year forward earnings expectations. So the way you can read this chart is that the share price tends to follow re-rating in earnings expectations. And really for utilities, that's come down to a couple of stocks that you probably can guess which ones. And for the gloves, it's really inflection from a very, very, very low base. So that's why the growth looks so phenomenal. So what we can see is that I won't say we are in a bull market territory this year, but certainly we're starting to have the ingredients for one. Market's very receptive to earnings upgrades and are rewarding it with very sharp share price rallies. But we can also see that some of the laggard sectors are like consumer and tech, where maybe expectations have not re-rated as much. Another interesting dynamic for this year is that we're seeing pretty decent inflows into the market. On the domestic front, EPF net contributions are growing at about 20+% as incomes stabilize. So putting out, excluding some of the COVID-19 withdrawals, EPF contributions are solidly back in the net contribution range. And this is going to continue to drive AUM growth in the domestic market. On the foreign inflows, you can see that we've been seeing foreign selling for quite a long time. In fact, if I draw this chart back, we've had fairly persistent foreign selling since 2018. We've seen some blips here and there, but you started the year with some decent foreign participation. And we're hoping that we are pushing Malaysia as one of our higher preference picks within ASEAN. We're hoping that the rebalancing out of China, some flows will come to Malaysia. And also the fact that we are positioned as an interest rate hedge against the Fed rate cuts, that will help our market as well. Foreigners are definitely a bit easier to hold on to our bonds. As you can see, the MGS foreign holdings are quite high, but foreign shareholding of equities has fallen quite a bit. So certainly we're coming from a very low base for foreign interest to be picking up, and that could be one of the drivers for the market this year. Although we see foreign interest being skewed towards higher liquidity names and also thematics. So they'll probably still be quite cautious around low growth, old economy sectors. So that wraps up my presentation. Maybe I can pass over to Meiji.
Yep. Yeah. Thank you, Ben, for your insights. It's also encouraging to know that in 2024 there's something to look forward to, with the returning of the inflows for the market and yeah, and also from the rebalancing of the China market and also the Fed cuts, and also that we are also number two in preference as compared to our region. Yeah. So for now, I'll open the floor for questions. Yeah, so to remind the participants again that you can type in your questions in the chat box. Um, so we have a few questions actually in the chat box. Let me start with the first one by Lisa. Her question is, what's the anticipated impact of global economy to the domestic economy, especially to the rubber glove and the oleochemical sector?
Yeah, so I think maybe specifically let's cover rubber gloves first. I think demand hasn't changed really, or will not change very much. I mean, fundamentally, it's a bit of a healthcare staple, right? The issue with gloves has largely been one of capacity. A lot of capacity has been added over the pandemic when the prices were high, and now the sector overall runs below capacity. And structurally, what has changed is that now you have Chinese supply competing with Malaysia, which historically has been the largest producer. And it doesn't look like the Chinese suppliers are going to, destroy their capacity. So as long as there's a lot of idle capacity on standby, it's always going to be a challenge to the sector overall, and that's something that is starkly different from the market dynamics pre-pandemic. So I would say for specifically for rubber gloves, it's a supply issue, not necessarily a demand issue. But specific to Malaysia, then it means that some of that production is being done outside of Malaysia, now in China. So that will hurt domestic production of rubber gloves as well. Sorry, I can't really comment too much on oleochemicals specifically, I'm afraid. Yeah, don't have any special insights there.
Okay. A second question from Haliza as well. So in your opinion, will the subsidy rationalization exercise will have any impact or any significant impact to the domestic demand?
I'm not sure what demand this question is referring to. But maybe again, just coming back to gloves very quickly, in case it's a specific one. I don't think this will have any impact on domestic demand for rubber gloves. If she's asking maybe domestic demand for gas, since the question is coming from Gas Malaysia. No, I don't think it will have any specific impact on gas. I don't think the government's looking to reform gas consumption just yet. But generally, direction for the market has been for liberalization, and the government wants us to pay more market prices for things. And we've sort of started to harmonize our gas prices already domestically. I guess in a disinflationary environment, generally when gas prices are coming down, that should help with prices a little bit. And I think demand really will be affected by industrial segments, for export rather than domestic demand. So short answer is that no, I don't think the subsidy rationalization will affect domestic demand. External demand will probably be the bigger factor indirectly for the gas.
Okay, thank you. As a follow-up to the subsidy rationalization question, so the subsidy rationalization would have ripple effects on the overall economy. Do you think that direct cash transfers be sufficient to spur consumer demand? Because usually the B40 will benefit from this cash transfers at the expense of maybe the M40. Yeah, so just want to hear your opinion on that.
Yeah, so the going in position is that the government should try to make sure that the B40 is no worse off. The M40, that one's a bit questionable how much the government wants to protect them, but they should, the government in principle is looking at this from a broader social assistance framework. They don't want the M40 to be too much worse off. And they'll be trying to, pull back the subsidies going to the T20 as well as to leakages. Will the cash transfers be sufficient? Honestly, I don't have a specific insight into how much the government will transfer. But hopefully, some of the math we've demonstrated in this presentation will give you some comfort that there is enough fiscal headroom for the government to give significant offsets here, to blunt the impact. Now, to say that it will be stimulative to demand overall, that one is sort of taking it one step further beyond the sort of no worse off. And our assumption here is that the government needs pretty strong buy-in, from the rakyat to implement a policy like this. So we think that the government could skew a bit more generous, especially for the B40. And again, because the B40's absolute household expenditure is so small, it's actually something that is not unrealistic for the government to implement. In contrast, the government is taking money away from the T20, but their consumption tends to be relatively inelastic, right? They're not going to consume a lot less simply because of the higher pump prices and general inflationary pressure on their basket of goods. So yeah, the short answer is that overall domestic consumption should be quite resilient, if the government is balanced in its policy implementation.
Okay. And then on another question on this fuel subsidy also. So we will expect higher fuel prices, for the industry. I mean, for the overall economy. Of course, this will have impact to various industries and sectors as due to higher fuel prices. Do you think that our companies, our PLCs, are ready for automation or digitalization? Yeah, to counter this high fuel prices.
I think our companies in general could invest a lot more in more efficiency. So higher fuel prices will specifically affect more industrial companies, right? Anyone that runs a lot of machinery, relies heavily on fuel. Basically, the government's been subsidizing all of these industries. We've already seen businesses having to adapt to higher electricity prices, right? So depending on where you are and the tariff, you could have as much as 65% increase in electricity prices. So this has forced businesses already to put in rooftop solar, right? Try to run their operations in a more efficient manner, So businesses will probably have to respond. They have to react to this. There'll definitely be a lot more investment coming in. Specific to digitization and automation, I think those are probably more specific to human resources kind of cost pressure. As I mentioned, the labor markets is very tight at this junction, and businesses are certainly looking at ways to reduce their staff costs or minimize the staff cost pressure. So yeah, I think that's also another theme that's ongoing in the background, maybe not directly coupled to the fuel subsidy rationalization. And generally, I would say that obviously actually still have a lot more automation and digitalization to implement.
Okay. There's a question from Lena. She's asking about ringgit. Do you have a ringgit outlook? Yeah. What is your ringgit
Yep.
outlook? Yeah.
Yeah, so over the medium term, we think the ringgit will be the second best performer in ASEAN. And really, we're coming from a low base. And a lot of this has to do with the narrowing spread with the Fed rates, right? As the Fed cuts, it will help us. But this will be somewhat offset by the fact that Bank Negara has to rebuild its reserves. Bank Negara has one of the lowest reserves in the region relative to exports. So really we do need to rebuild that reserve position. The weak reserve position has been one of the reasons that Bank Negara doesn't actually have direct ammunition to reduce volatility in the ringgit. So the ringgit has been especially volatile, especially on the downside. And also, the Bank Negara has extended a lot of forward liabilities to try and sort of minimize some of the pressure on the ringgit. But of course, that only further reduces their net reserve balance. So Bank Negara does have to rebuild those balances that will offset the ringgit strength. But maybe another factor that will affect us as well, of course, ultimately is how whether the US goes into a soft landing or not. If the US goes into a hard recession, that will probably put the market back into a risk-off mode, and generally that will punish emerging markets like Malaysia. So yeah, we kind of have to have the sweet spot where the US economy has a soft landing. This is still our base case for a soft landing. And the US also cuts rates quite significantly. Those will be the two main drivers for the ringgit, and we are thinking 4.5 for this year.
Okay, thank you. A question from Justin. Yeah, so the question is about property sector. So property sector has been one of the top performer in PLCI in 2023. Is there any more leg room for further growth in the sector in 2024?
Yeah, the property sector has been an interesting one. On paper, we've had record sales, right, past 2 years post-pandemic. You can argue that some of that is pent-up demand, because sales couldn't really take place during the pandemic. And momentum seems to still be quite strong. But one thing that's noticeably missing from the property market is this, maybe a bit more of a speculative element, right? We're not really seeing the house price index move in a big way. And this is really interesting because raw material price, labor costs all have gone up. So developers, while sales numbers look good, this may not necessarily translate to better margins, or at least all else equal versus pre-pandemic, right? Of course, versus during the pandemic period, they're going from a loss, they're going to look good on a relative basis. So I would say the property market is probably moving past the recovery cycle. I don't think we are necessarily in a bull market yet. And whether we can push it into a bull market, remains to be seen. Rates, I think, has been a focal point. Or people, rates are up, but really the rates are back to its pre-pandemic level. It should not be detrimental to demand for property. In fact, let me pull up a slide here. I think you have some good data here. Yeah, so you can see this light blue line, residential property. This is loan applications. It's still very strong. So there's clearly a lot of demand for property. Rates are not destructive, have not been destructive to this demand. But the missing element so far has been speculation and a run in the house price index. But the developers generally have lowered their inventories. That's helped. And yeah, I would say the property market probably has some room to improve if we can go into a speculative run. But I would be only cautious on the fact that developers have been not able to pass on the cost just yet. It shows some resistance from an affordability perspective.
Okay, thank you. Yeah, another question from Peter. He's asking about the utility sector. So the utility sector has been doing the heavy lifting on the local front. So what do you think that direction will be heading?
Yeah, I think the utility sector still has more legs, right? Some of the heavyweights within the sector haven't moved as much and are still being held back by uncertainty around policy execution. So specifically around the NETR. I think a lot of investors foreign investors in particular, have avoided the sector because of the legacy coal exposure. So while our utilities are saying that they want to reduce their coal exposure going forward, they don't really have much choice in the matter because they're sort of tied to the national energy policy. And while the NETR has definitely some good headlines, the actual policies to enable the NETR haven't been fully implemented yet. There's still some uncertainty there. That said, the government has announced the new LSS5. We saw a huge announcement, right? Last year, the government sort of greenlit energy export to Singapore. So the pieces are falling in place. And I think that's really encouraging. But the government still has to finish up the sort of policy roadmap with the third-party access so that you can sell power directly across the grid and pay a wheeling charge to the transmission. And also, just to clarify, how the single buyer will be restructured, so that people who want to invest in renewable energy have a clearer picture. So I think with this policy clarity, some of the heavyweights utilities can continue to run further. Another specific thematic tailwind here will also be data centers. So the global economy is basically defined by energy, limited by energy. and increasingly so because of this emphasis on taking out cheap fossil fuels and replacing it with, generally more expensive renewables. And one of the biggest consumers of electricity is data centers, right? So it can be anywhere to 6-7% of your national grid energy consumption. And we saw, for example, Singapore hit that limit and impose moratoriums on new data centers. Singapore is still, like, to think about it, the Changi Airport of the region, all the submarine cables for data land in Singapore. So they're still the hub, but they probably can't build new data centers there, all these huge ones. So that's sort of given Malaysia an opportunity to build data centers. And you can think about it as an indirect way to export energy, because instead of selling electricity to, let's say, Hong Kong, they can just send their bits and bytes down to a data center here. We can process that data and send it back to Hong Kong, right? That's an energy intensive business. So you can think about data centers as indirect energy export, and it's really doesn't have geographic limitations like transmission of electricity, which has a lot of transmission losses over large distances. And that's a thematic that's also driving the sector, particular in Johor. Yeah.
As a follow-up question on the NETR, based on your observation, what are the key success factors in implementing NETR? For example, if there are any specific components that face challenges or seem particularly effective?
I think ultimately, when it comes to energy policy, there are a few stakeholders to balance, right? The rakyat wants the cheapest electricity, but at the same time, we need to make sure that there's energy security. We can't just implement renewables, for example, but give up energy security, which is why, for example, gas is still very much part of our roadmap for now. But we may want to move away from coal, which it becomes increasingly difficult to finance. So I would say the main thing that we need to see for this transition to be successful, the roadmap to be successful, is clarity on some of the immediate moving parts which I mentioned, like the TPA and the single buyer. But over the medium term, it's making sure that somehow the government has the political will to see through some of these transitions, because there will be likely higher energy costs going forward, and how that is spread out, right? Are you going to heavily penalize industrial users, try to protect households? Striking that balance is very important. It's also important that the government educates us as well in the context of what we are gaining, right? So if we continue to be fully exposed to, let's say, fossil fuels, we'll be very exposed to volatility in energy prices in the long term. The government has historically used the fiscal balance sheet to protect us from it. But if you think about energy in a 20-30-year horizon, there's going to be huge spikes in energy prices along the way, and increasing the renewable mix in the grid will protect us from that. So yeah, those would be the factors to think about.
Okay, thank you. I would like to encourage and also remind the participants to key in maybe the last question in the chat box if you have. Yeah, and I've got one question here by Lena. She wants to know about your observation on the impact of the Madani framework.
I mean, the Madani framework, to be frank, is a rebranding of a lot of old ideas, and I think the policy itself is less important than the execution. So from my perspective, I just want to see the government get more things done. I think what I've covered today, right, as a sort of focal point, one of the main policies, is difficult. You need a lot of buy-in from the rakyat. It's not very populist. If the government can get some of the difficult stuff done, it'll give me a lot more confidence in their broader policy, think about it, portfolio, right? What else can they get done? And I think that they've certainly got a lot of bright people in the government working on this problem, despite some of the missteps maybe on the launch of Padu. And really, it's execution at this point in time, follow through. So I wouldn't pick Madani as a broad theme and be excited about Madani per se, but really what gets done.
Okay. And maybe we take sorry, you wanna?
I see a question in the Q&A box here about Yeah. So have you seen the return of foreign funds? Short answer is yes. We can see it in the actual flows data, which is encouraging. But also inquiries for the Malaysian market are picking up quite a bit. I think the foreign interest has been very skewed to thematics, things in new economy. They're still avoiding sectors like telcos, for example. There definitely a lot of interest. There's definitely a lot of interest in tech in Penang, for example. And that's of course again thematic, right? They wanna play Malaysia as a supply chain diversion beneficiary. Um, Will there be more to come? I mean, certainly, I hope so. We're coming from very low base. We're near rock bottom kind of foreign shareholding levels at 19.5%. Sort of, it's only up from here. But I think the kind of companies that we have on Bursa Malaysia kind of hurt us as well. Like I mentioned, there's some sectors that foreigners just won't touch. Plantations, telcos, some of the cyclicals, right? Not in favor right now, like petrochemicals, they can't touch or won't touch. We also need to give them better things to buy. Maybe it's another way to answer that. But whatever they find interesting, there's definitely a lot of attention there at this point in time. And hopefully, it keeps going. Yeah.
Yep. So yeah, I guess that's the last question from the floor. Okay, I guess it's 5 minutes to 12. Maybe we wrap this up, and yeah, thank you again, Ben, for joining us, and for your insights. And thank you all the participants as well for joining us today. We hope that this webinar is useful to you, and do go to our RF4E website for your IR materials. Thank you again. Yeah, and have a good day, and Hong Si Fa Chai as well. Thanks.
Yeah. Good day, everyone. Thank you. Bye.